Hello and welcome to interest.co.nz. I'm Gareth Vaughan and I'm at the Reserve Bank with Governor Adrian Orr, and we're here to talk about the final decisions in the broadest review of banks' regulatory capital requirements that the Reserve Bank has ever done, I believe, Adrian. Thanks for your time. Big day for you guys and us covering it. Just a few questions, and I thought if I just kick off by asking, the New Zealand banking system currently appears reasonably robust and sound, and as your financial stability report recently did say. So against that backdrop, why do banks need to make a 50% increase in their high quality capital, and why are you moving to a capital scenario whereby you think you can prevent a banking crisis from happening no more than once every 200 years?
Yeah, and the short answer is because we can have an even lower probability of default without giving away any expected economic growth. In fact, our work showed that we can have both more expected economic growth with a lower probability of default. So we weren't in an optimal position, and this is about taking us to that optimal position. Banks will be safer, they will be able to lend better through good times and bad. You'll get better customer outcomes, and all of that means that we're better off overall society-wise.
So did the RBNZ come to the decision that you didn't feel banks were safe enough at the moment?
We've always wanted to have a very first principles look at the level of capital, and it's a non-trivial task. It's taken us 3 years of research, the last 12 months of working through the submissions, a very broad group of submissions, and the idea was to build a framework, to build the analysis, to build the data, and to listen and learn from the banks and international experts themselves to look for where is the sweet spot for the New Zealand financial system. So too often we're having to just accept international regulations for New Zealand, a small open economy, a relatively thinly based economic footprint, and with that a highly concentrated banking sector and a banking sector that dominates the total capital market. So we would always think more capital relative to the world would be an obvious starting point. How much more for that? And so the analysis brings it out. And we put, the net benefit there we see is about $1.25 billion per annum to the New Zealand economy by having a safer bank and retaining the efficiency.
That net benefit you mentioned, $1.25 billion?
Yes.
Yeah. How did you get to that?
It's a challenge, and it's well articulated, but really it's about saying, how do we expect the economic growth to be developing through time? How much? What's the probability of a banking crisis? What's the cost of a banking crisis? How do you get that probability and cost trade-off compared to the ongoing growth? And so it's a net benefit. You're saying economic growth through time minus the costs of banking crises and reducing the probability of those banking crises. Where's that sweet spot? So in a sense, it's not a lot different to insurance, saying how much am I prepared to pay to avoid something happening, or if it happens, to be settled for it. And so taking that insurance framework. All the workings have been made available to the vast, international experts and the banks themselves, and it's come out at a very robust nature. Too often people just want to focus on the costs, not what they've bought for it. And we've said it might be about 20 basis points on average through time on additional interest costs, but the benefits significantly outweigh the additional cost.
You've made that estimate of the 20 basis points increase to borrowing costs. Do you have an estimate for deposit rates for savers?
Well, really it's going to be in the hearts and minds of the banks themselves around what it is. So all we're saying is that relative to otherwise, there would be a 20 basis point increase, so 1/5 of 1%, and that's an estimate. How banks do their business, it's competitive between the margin between what they lend and what they borrow at. Some banks have better options of borrowing wholesale rather than just depositors. So, and we've given banks more options through the decision today as well around redeemable preference shares. So we're giving them a mix of funding, and they can work out how they best want to allocate that between the borrowers, the lenders, and the bank margins.
Who do you see buying up the bulk of the redeemable preference shares? Are we looking at retail investors, institutional investors, local, foreign?
The good news, it'll be a combination of all of the above. We received very positive feedback from both international and domestic investment banks to say these would be highly sought after. There's a deep liquid market for these types of investment assets. With interest rates low, these are great opportunities. So we believe that the up to around the $9 billion potential raise over the next 7 years will be relatively straightforward, should banks choose to use that as well. So it's optionality for banks, and it's a positive externality for investors. You know, it's a new instrument in town. They're highly regular in the US banking system, for example, and we've been testing them for the appetite here, and it seems very positive.
You mentioned in one of your previous answers about the international banking standards. This RBNZ Capital, certainly when the proposals came out a year ago, they perhaps looked a bit unorthodox by international standards, quite New Zealand specific. To what extent are these developed because you do view New Zealand as quite a unique market with, I guess, four big banks from overseas dominant here? And I guess off the back of that question too, what message are you sending to the rest of the world today?
We're sending the message, I'll start at the end there, the core message so the banking, these capital models largely come from the Bank of International Settlements in Switzerland. The very first thing they say is these are models for on average. Take this and then adapt it to your country or your financial system. People forget to hear that second bit. So take this tool set and use this tool set for your country. And that's what we've done. So every country has got its own unique, particular combination of both level of capital, nature of capital, for their own unique financial system. And for us, we have gone from the first principles saying, well, starting from the Basel criteria, what do we need to have different or better for our situation? And so the outcome is exactly that. We've got all of the right Basel flavour with the unique New Zealand calibration in there. And most of that calibration came through in the final level of capital, but we haven't done anything to the risk weighting frameworks, for example. And I have to say we've had a lot of confusion, in part deliberate out there, around what will it mean for some parts versus other parts in the economy. Nothing we've done today changes the risk weightings of it. It's simply about the level of capital.
And you've had a good look at the internal models approach that obviously the big four banks are allowed to use. You're keeping that in place, but you're obviously lifting the minimums to 90% of the standardised model that other banks use. Were you close to actually doing away with the internal models approach completely? I
think we've always been quite close to that, but again, part of that global citizenship, we have to listen and be prepared to hear the banks who are advanced modelers, as it happens to be the four Australian banks, but it's a licence they have to continue to earn to keep. And that licence is about showing the capability of being able to do this modelling, and then the deliberation and actually running these models. And we've been less than impressed with what has happened over recent years, with a lot of banks being signed out to use these models, but then just not meeting the requirements. Part of lowering that, the difference between a standard and an advanced model means that we can be less concerned about modelling mistakes or reporting mistakes on the actual impact, because it's an 85% gap. But more work is needed in this space by all of the banks who are using these advanced models. They really have to say, are we doing it right? Are we using these models? Is it worth the effort?
To what extent do you want or hope these new capital requirements to, improve the competitive landscape in New Zealand banking?
Yeah, it's been interesting because the competition question is not at all inside of the framework of what we went about. It's about the probability of default, the loss given default, and the skin in the game to make sure they're lending. But a positive externality of all of this work is it does make the field more competitive. You've got more access to different funding instruments for the smaller banks. You've got less of a competitive advantage for the advanced modelling versus standard, and that was never meant to be a competitive tool. It was meant to be a risk allocation tool, but we found banks using it for quite a different purpose. So that's again a great opportunity for banks to be able to compete. And also, a lot of the discussion about, well, we're not going to do this and we're not going to do that. Well, it is time for other people to say, well, we might or we could. So show true signs of that competition going on.
Now, obviously, we've mentioned the 20 basis point increase to lending costs that the RBNZ expects. Some of the economists at the trading banks are predicting, you'll be stunned to hear, a higher figure than that. How will the RBNZ respond if banks are increasing lending costs and or cutting deposit rates by more than that 20 basis points and blaming these capital requirements?
Yeah, I think, sunlight is a fantastic disinfectant. And, from what I've seen, I know our analysis, I know the international robustness of our analysis, and I'm incredibly comfortable with where we are at. I've seen some analysis which says, well, it's a back of the envelope. So I would hope that the competitive nature of this banking system calls that out. You're going to be able to watch the behaviours. We will make sure that's highly transparent, and consumers are going to have to act and be part of that competitive discipline. Because, as I said today, to be frank, a 20 basis point possible higher than otherwise interest rate is not saying banks must raise by interest rates. It's saying this is absolutely lost in the wash of other things that matter. I'm impressed that some of the bank's economics teams are even talking about their own bank capital now. They're kind of putting the two engines together. So I see that as a great advancement, but I am incredibly confident with our numbers.